Objectives of financial planning. Like any other type of planning, financial planning is also considered to be a purposeful activity. It is undertaken by the financial managers in order to achieve certain specific objectives. The twin objectives of financial planning are described to ensure availability of funds whenever these are required. Finance is a scarce but an essential resource to carry out the activities of a business enterprise. Sound financial planning helps in timely and adequate availability of funds, which is important for smooth running of a business enterprise. To see that the firm does not raise resources unnecessarily. Each source of finance has a cost attached to it. Therefore, excess funding is likely to have an adverse effect on the cost-benefit ratio. The ideal funds do not create any benefit unless utilized in the best possible manner. Thus, effective financial planning helps to estimate and utilize funds appropriately. So, what are the features of financial planning? The salient features of financial planning are stated. First one, financial planning is the process that involves estimating the amount of funds required by a business enterprise and also determining the sources from where it will be raised. Financial planning is done by taking into consideration various aspects like growth, performance, investment, and the requirement of funds for a given period. Third one, financial planning is done both on long-term and short-term basis. Fourth one, the long-term financial planning relates to capital expenditure and facilitate the growth of the organization through sound investments. A short-term financial plan is called a budget. A budget is a detailed plan of action for a period up to 1 year. Ideally, financial planning is done for 3 to 5 years as it may be difficult to anticipate situations beyond a certain time period. Next is financial planning process. The various steps involved in the process of financial planning are outlined with the help of an example. First one, financial planning starts with the preparation of sales forecast. It requires an estimate of the sales which are likely to take place in the next 5 years. On the basis of these estimates, the financial statements are prepared by taking into consideration the funds required for investment in both fixed capital and working capital respectively. Further, an approximation about the expected profits during the related period are also made in order to assess the proportion of the financial requirements which can be fulfilled internally through retained earnings. The difference between the total estimation of funds needs and the quantum of funds which can be generated internally reveals the requirements for external funds. Once the quantum of funds to be raised externally is generated, the various sources are identified and evaluated by taking into account related factors and the cash budgets are laid down. The next one is the importance of financial planning. The importance of financial planning are sound financial planning ensures smooth running of an enterprise as it helps a business to face the uncertainties arising due to the dynamic nature of the business and facilitate smooth working of the business enterprise. It helps to prepare backup plans to deal with all kinds of contingencies. For example, if a growth 30% in sales estimated in an automobile company, the financial planners will also create provisions to meet both an increase or decrease in sales effectively up to a variations of say 10%. This is done by preparing blueprints to deal with multiple situations. It helps in anticipating future requirements. It facilitates coordination. It increases efficiency and it helps to establish a link. It provides a continuous link between investment and financial decision. It facilitates easy performance as evaluation standards are set clear, specific, and measurable terms. These are the importance of financial planning.